Well, welcome to Should I Consider Oil and Gas Government Tax Subsidized Investments? This is a very popular topic, a very seasonal topic with many of our clients. This is a presentation done by Cunninghamlegal. I have two guests here with me today, Christina Lindsay and Chris Spence. They are both working in the financial services and investment space, but they're here as guests of Cunninghamlegal. And it's very important that these are, and Christina can talk to that, but there's no offer to sell anything. There's no solicitation. This is a law firm giving a lot of people, quite frankly, valuable advice. So this is also not, I'm a lawyer, my lips are moving, words are coming out of my mouth. This isn't legal advice. Go ahead and subscribe to our YouTube page. If you're watching this on YouTube, this is a live webinar that's being recorded. And again, if you do have questions, go ahead and put them in the Q&A. If you have questions or comments and you're watching this on YouTube, you can put them in the questions and comments. So I will say, what's going on here? How can we help? What does Cunninghamlegal do? What are Christine and Chris doing here? Most people want to pay the least taxes possible while securing a legacy for their family and their loved ones. We're here to help you craft a plan, give you options, and make recommendations that are part of an integrated plan to reduce the overall tax bill, leading to more wealth for yourself, your family, and your loved ones. And I will tell you, and then I'll turn it over to Christina and Chris. I'm telling you, I'm a tax lawyer. I don't think people think enough about taxes. Too many people wait until, the tax year is over and they take their shoebox in of receipts to their tax preparer and they say, do your magic and reduce my tax bill. That's way too late, right? So you guys are very fortunate because you're watching this at a time, and Christine and Chris will cover this. You're watching this at a time where there's a lot that you can do to mitigate your tax bill, not only for this year, but in years that follow. So with that, Christina and Chris, Christina, if you could introduce yourself, and Chris, that'd be fantastic.
Yeah, so Christina Lindsay Orta here with Ascent Wealth Management. And really, I'm just here to help facilitate bringing Chris in here. Chris Spence is with Mewbourne Oil Company, and he's going to give us a good overview of the oil and gas space and Mewbourne and how they operate. But I am a certified financial planner, and we handle and cater to the clients of Cunninghamlegal. And what we would do when it comes to oil and gas with our clients, we do use oil and gas with our clients for the right client. It is accredited investors only that have a pre-existing relationship with Cunninghamlegal or Ascent Wealth Management. So there has to be some pre-qualification done, ensuring that the investors are accredited and ensuring that this is suitable. It has to be in the best interest of the client first and foremost, and above all else, it has to make sense for the right client. That being said, I spent 7 years of my career in private equity prior to working with individual high net worth clients myself. In the private equity world, we were exposed to many different oil and gas companies, and there are a lot that are companies that you would not want to do business with. What is very common in the oil and gas space is some front loading of expenditures and just to get tax benefits, and ultimately the underlying investment vehicle doesn't make sense. So one of the key things, especially with my background in private equity, is making sure that the underlying investment vehicle makes sense aside from just the tax incentives. And so we're going to get into a little bit of that. Yes, I want to be very clear that this is definitely not an offer to buy or sell securities, but just to educate clients on oil and gas. Chris, I'm going to go ahead and turn it over to you.
Yeah, no, thank you. I appreciate that. And thank you guys both for inviting me to participate this afternoon. Just to give everyone a little bit of backstory and history about Mewbourne Oil Company. You can see here we were founded in 1965. We are currently the single largest privately held independent oil producer in the United States. We actually produce today closer to 120,000 barrels of oil a day, and are the most active privately held operator in the United States. That's based on rig count. And in fact, I think we're maybe the third or fourth most active oil company, public or private, in the United States based upon rig count, which today we're running 16 rigs. 14 of those would be in the Permian Basin of West Texas and Southeast New Mexico. which is where Mr. Mewbourne drilled his first wells in July 1966. And then 2 of those rigs would be up in the Anadarko Basin, up in the North Texas Panhandle and Western Oklahoma. We're headquartered in Tyler, Texas, which is where I live and work. It's a sweltering 103 and probably 90% humidity today. So that's why we're doing this inside. Summer is the reverse winter for what you'd think of most parts of the country. But nonetheless, we've got nearly 500 employees. There's about 120 or so here in Tyler, and the remaining 380 or so are actually out in our district offices, which you can see identified there in Amarillo, Perryton, and Midland, Texas, Hobbs, New Mexico, and Woodward in Oklahoma City, Oklahoma. In total, we've drilled somewhere close to around 3,000 wells since our inception and currently operate around 2,300 of those. And as you'll see on the next slide here, I know that there's maybe not a lot of you that are familiar with some of the areas that I mentioned as far as our district offices, but you can kind of get a bird's eye view here as far as the Permian Basin and the Anadarko Basin. The Permian, again, being West Texas and Southeast New Mexico, and the Anadarko Basin being the North Texas Panhandle and Western Oklahoma. You can see Tyler over here on the eastern side of the state. And then, like I mentioned, our district offices that are strategically located throughout those 2 basins. And, you know, Christina can speak to this firsthand. In fact, she and her partner and Father John had a chance to come out on a due diligence meeting. Christina, when was this? 3-4 years ago, maybe?
This was actually probably 2017, I believe.
Okay.
Now. So,
Okay.
you know, but that is one great thing to bring up. And my father, John Lindsay, who has been working with Jim, you and John have been working together for close to 25 years now. And John actually put himself through grad school to working on the oil rigs in Alaska.
That's true. I forgot about that.
He's very familiar with that space, and John and I took the opportunity to go to the actual headquarters, meet with the executive management team, meet with the engineers, understand the business model, the financials, the people that are behind Mewbourne Oil Company. And then we physically went to the oil fields in Carlsbad and Hobbs, New Mexico, and we went on the rig and got to see everything that they do. So there's definitely a significant level of due diligence that's been done.
Yeah, I was going to say that's the best kind of due diligence. You go out to where the thing's happening. You go, yeah, there really are oil wells here. Imagine that, right? It's not fake. So
yeah, we saw Halliburton doing, you know, some of the initial drilling, and we saw, you know, Royal Dutch Shell coming to pick up and truck off the oil. So we got to see it all.
Yeah, it's a good trip. It's certainly I guess an easy way or a good way to get your feet dirty. But I guess the good point, I think, and Christina kind of just hit on this too, is, you know, as opposed to a lot of upstream oil and gas companies that have really consolidated over the course of the last few decades and are centralizing a lot of their decision making to say a single facility in, you know, Dallas or Houston or Austin. Mr. Mewbourne has designed this company very similar to what the old Hunt Oil was, which is really just a boots on the ground company where we've got our own engineers out in the field as we're drilling wells, as we're completing wells, as we're producing wells. We have our own geologists designing these well plans. We have our own geophysicists out in these offices. We have our own land offices and our own landmen out there sourcing these deals. Now, obviously, we have a good handle on all of this, flowing back to Tyler through some various technology that exists today. And one's called a pacing system. I won't bore you with it. But nonetheless, as I think Christina just reiterated and hit on, these are our people out on location making decisions. And that's, again, I think something that's you know, somewhat attributable to our success over the past, you know, 50 plus years. But, you know, one of the things that you mentioned at the onset of this was that there are still some fairly generous tax benefits associated with this type of investment. And so, Jim, if you go to the next slide, it kind of dives in, you know, head first to talk about the 3 primary ones. And this is under current tax law, but the IRS would allow an investor to deduct all costs associated with drilling an oil and gas well that are considered non-salvageable or otherwise known as intangible. So it's the IDC deduction. And typically, no matter if you're drilling wells in New Mexico or North Dakota or Pennsylvania or Colorado, approximately 75 to 80% of those overall costs are going to be considered intangible. And as such, you're able to deduct that against other forms of non-passive income that's passed through to you on a K-1 which we'll show you here in just a second. But in the consideration of, those of you out in California that have the, oh gosh, what do I say this? The honor, if you will, of paying in some cases north of 50% of your earned income to the city, state, and federal government. This is something that has, I think, been attractive, especially as you've lost the ability to deduct other things from mortgage interest, state income taxes against your federal, and so forth. So again, for each dollar invested, typically you're going to generate a loss equal to around 75 or 80 cents. And those are from the costs that would be associated with drilling and completing the well. They would otherwise be characterized as non-salvageable or intangible. You then have depreciation on your tangible costs. And so if we assume that 75% of the costs are going to be expended on intangible costs, then the remaining 25% would be your tangible equipment. Those are things that do have salvage value if you had to walk away from the well. And currently under current tax law, we do have accelerated bonus depreciation. And so you're accelerating that schedule. That's a nice benefit, but it's certainly a much smaller piece of the overall tax benefits that are associated with this. I would say that the last one that's identified on here is the depletion allowance. This shelters 15% of gross revenue from producing properties that are outside of a loss position from federal taxation over the life of that asset. And so typically what this ends up being is maybe, again, anywhere from 17 to 20% of net revenue that's sheltered from federal taxation over the life. So to kind of go back up to the top, you have the IDC deduction, which again is going to generate a loss equal to maybe 75 to 80 cents for each dollar invested. You then have depreciation on your tangible costs, and then you have the depletion allowance, which is what's going to shelter a portion of that revenue over the life of the partnership. What is, I think, important to note here, guys, is there is an election that has to be made at the time of subscription, and that is whether or not you want to be a general partner or a limited partner. And I know Jim can speak to this ad nauseum. I know Christina can as well too. But in short, as a general partner, you're considered at risk in the activity. Therefore, you're defined as being jointly and severally liable for all debts, losses, and liabilities of the partnership. The reason that an individual would go in as a general partner is if they want to take that IDC loss against non-passive sources, you have to be at risk. And so if you want to take it against, as it says here, W-2 or 1099 or capital gain or whatever it might be, you've got to be at risk. If you have passive sources of income that you want to use that loss against, you can go in as a limited partner, at which time your at-risk definition, if you will, is severed and your liability is capped at your investment in the partnership. But in terms of what it means to be at risk, the most common question I know that Christina gets is, what protections are in place for a general partner? Because candidly, guys, the whole idea of being at risk for all debts, losses, and liabilities of anything, certainly something that you might only have a very small percent ownership in terms of this partnership, can keep people up at night potentially. So what do? First and foremost is insurance. The partnership is a named party, in our case, to the exact same insurance policy as the Mewbourne family. And we can talk about kind of the meaningfulness of that as we get a little further on. But I think it's just important to note that the single largest investor in the drilling program each year is named party to the exact same policy as, in our case, the partnerships. You then have the assets of the partnership itself that could be pledged in lieu of the general partner. And then finally, we indemnify the investor general partners to additional loss through the assets of one of our affiliates, Mewbourne Development Corporation. So those are just some of the different protections that are there, but I don't want to dive too deep into that yet. We can go back to it later if we need to, just because there's a more, technical discussion here with regards to the K1 and how it is that these losses are reported. So Jim, if you want to maybe go over to the next slide here. So like I said at the onset, all income and losses are reported on K1 annually. Christina can attest to this, that these are typically out by the first or second week of March. And it's actually fairly straightforward. The biggest misconception that exists with regards to losses from an oil and gas limited partnership is that a solid majority of tax preparers assume that the investor, because they're not a material participant in the business, cannot take this loss against non-passive income sources. But there's a section of the code, which is 469C, that's called the non-passive working interest exception, that allows you to be at risk, hence going back to what we were just talking about in terms of your election if you want to be a general partner, and then being able to take that loss against non-passive sources. So long story short, if you look at a sample K1 here, there's essentially 3 boxes if you're not self-employed that you'd want to look at, potentially 4 if you are able to take advantage of the section 199A qualified business income deduction, which would be in box 20Z. But for the majority of individuals that are investing in drilling programs that have to be accredited, you probably phase out because of your income. But anyways, box 1 is going to show your ordinary income or loss. Box 13J is going to show the intangible drilling cost deduction loss. And then box 20T is going to show you your depletion. The only thing that's potentially different for someone who's self-employed is that you would be using box 14A as well. And the reason that this is important is that if you elect to be a general partner, the income or loss is considered self-employment. However, when you're converted over to a limited partner, and we can talk about that a little further down the road, it's no longer considered self-employment. And so the beauty of this is that if you are self-employed, you can take that loss in the first 2 years and use it against your income. But because unlike someone who's W-2 and has their withholding from their employer, you don't have that benefit as a self-employed earner. And so you actually get an additional benefit here if you are self-employed, although I wouldn't call it material in nature. So Jim, if you go over to the next slide.
Yeah, Chris, I just have one question on this. I'm looking at box F. It says $30,000 investor. And then if you look at box L, it shows beginning capital account. Is this the first year of the investment or the second year?
This is the second year. So this was this example was actually from the 2014 partnership in tax year 2015. So this would show the second year. So the capital account adjustments would take into consideration not only any compensation that was paid at the onset, but of course your income and loss that had been derived up until that point as well.
Okay.
So one of the more common questions that we do get is AMT, and I know that that it's somewhat watered down now post 2017 tax reform, but it is still in place. IDC is important from the perspective of AMT because it's not considered a tax preference item unless it exceeds 40% of an investor's AMTI, their alternative minimum taxable income. If that is indeed the case, that it did exceed that 40%, then there's a calculation that you would have to run to determine what percentage, if any, of the IDC you have to add back for AMT. I've been in this business now for 17 years. I'm familiar of only a handful, maybe 2 or 3 cases where that's actually ever been an issue. But again, I think this is important because for a tax preparer that's not familiar with a drilling program, they may automatically assume that you're trying to take an additional deduction above your AMT, where in this case, you're actually able to utilize this loss just because it is not considered tax preferenced for AMT. And so I don't know if you guys have anything in addition to add to that, just because I can't remember now what the parameters are with regards to the alternative minimum tax. But it is something that you're going to want to look at just to make sure as you're filing your return if you are utilizing these losses.
Yeah, Chris, you raise a great point because on some of our other webinars, we've had a picture of the A team from the 80s, with Mr. T and George Papard in it.
Right.
Really, this is about assembling your A team, right? And sometimes people come in and they're advisors. They might have a CPA who says, I don't know about this. That's what Christina and I are for. We're part of that A team. And, we educate the CPA or whatever we're doing, but that's also, it's very helpful. So it's good to have people who are trained and knowledgeable in this, because I would hate to see people leave money on the table and overpay on taxes.
Well, and I want to address one thing too. One of the important things is working with the CPA, making sure that this makes sense for the client, and how the CPA is characterizing the deductions. I've had several clients go, my CPA is not getting the deduction from the investment that we did. Well, they weren't checking the general partner box. And so therefore it wasn't calculating the deduction. So knowing how to coordinate with the CPA, making sure this makes sense for the client. What I will say is, in defense of the CPAs is there are many CPAs that have seen a lot of dogs with fleas in this industry. And there's a lot of oil and gas deals that have just not panned out well. And some of those have been offshore drilling rigs, different types of structures, but probably the most common flaw is companies that have front-loaded expenses to get a high IDC deduction. And so I kind of wanted to take a moment to walk through the timeline for a moment. Typically Mewbourne raises capital, would you say July, August, September every year, Chris? And they do
correct.
They do one partnership a year, and they don't start drilling until probably November, or putting the rigs on, working on the actual wells that are allocated to this year's partnership. They don't start working on until probably November, December.
Mm-hmm.
Therefore, you really justifiably could not say that 90% of the partnership of your investment is expended in this calendar year. Therefore, you're not going to get a deduction on 90% of your investment in this calendar year. What many companies do is they will front load expenses to get the highest deduction you can for this year. And then ultimately, if the revenue doesn't pan out to offset those expenses, you end up at a loss. And so I can say from experience, and certainly in defense of CPAs that have seen, again, a lot of bad deals, that is the number one flaw in the structure. So this is not a get quick tax deduction strategy. That is not what this is, but it is a methodical part of the plan, especially for clients that we know are going to continuously have a high tax problem, are continuously thrown into the 53% tax bracket, or especially if you've got the sale of a business taking place next year, you're going to have to recognize a large capital gain next year. You're preparing for large RMDs. We use this a lot with our clients that have, in multiple six-figure RMDs, which is a required minimum distribution on their IRA. And we've got several clients that have, they're retiring. They've got 5 years of deferred comp income. They've also now got these six-figure RMDs coming. And every single year we do an oil and gas investment with Mewbourne, because if you do this consistently, then you can start to kind of benefit from year 2 on roughly an 80% IDC deduction each year. But in the first calendar year, you're typically recognizing, around 15 to 20%. Would you say that that's fair, Chris?
Yeah, I think it outlines it maybe a little bit in the next slide. Is that right? If I'm not mistaken.
Yes.
Yeah, here you go.
Yeah, so I'll let you speak to this in a little bit greater detail here, but I do want to just say that what a lot of our clients will do when it's as a planning vehicle is they'll do an investment in year 1. You're only going to get 15 to 20, maybe 20 to 25. But you're going to get a smaller deduction in year 1. In year 2, you're going to get that additional deduction where you're typically going to total, you're going to range around an 80 to 82% total deduction typically over the course of those first 2. Sometimes you might have a 3 or 5% deduction carry over to year 3, depending on the demand. So with that being said, if you do year 1 and you do another investment in year 2, you're getting that deduction for that year 2 investment, that 15%, 20% in year 2, plus the prior year. So you're kind of then riding that 80% from that point forward. And that's really where a lot of our repeat clients that are high W-2 earners, looking at high, RMDs, consistently pushing themselves into a high tax bracket in California, they just do this year after year. It's part of their planning.
Yeah, I think you hit all the high points there. Just to kind of reiterate, I think what you had just said, and we're aware of it. We've seen it. We've heard it on the phone. We've heard it in person. We've heard it from you here firsthand as well too. I like your analogy that there's dogs with a lot of fleas, or I've said before that there's sadly a graveyard that's long and wide of failed drilling programs, because what you've had is a lot of just promoters that are out there selling these massive tax loss drilling programs that have no underlying economics. The reason that some of the most valuable publicly traded companies in the world are oil and gas companies isn't because they've successfully harvested losses and can't generate a return. It's because they can generate a return, and in some cases have been able to utilize different tax strategies to potentially help offset some of their income. And that's basically how we approach the business. Or said otherwise, we try not to let the tax tail wag the dog. You have to make a return at the end of the day, and that's what the most successful oil and gas companies have done. Whatever the IRS allows for is really just the cherry on top. And in this case, of course, it's some very generous deductions that individual investors are able to utilize. So I guess just to kind of summarize this slide up here, and then I know that there's some discussion with regards to not just environmental, but also some potential legislation. But typically, again, you're able to get a deduction equal to around 75 to 80% of your initial investment, of which in our case, you're going to spend some of the money this year. Maybe it's equal to 15, 20, maybe up to 25%. But you're going to get the bulk of your loss in the second year, because that's when you're spending the bulk of the investment is in that second year. And so typically it's in that maybe 50 to 55 or potentially up to 60% range. So I think that's pretty much it as far as the tax discussion. We can maybe table that if you want, or if there's any questions on that, feel free to ask them now, or if you want, we can just kind of pivot into the environmental consideration side.
Yeah, I do want to spend some time on the environmental, and then we'll also get into the cash flow, because we talked about the tax benefits, and I want you to talk about the royalty income that ultimately, again, the cash on cash returns have to make sense for the client, if it not just the tax benefits. But while we're
Sure.
on this, I think it's really important to talk about the environmental considerations and how Mewbourne does things. And I think what I'll kind of lay the foundation to, in having visited the sites in the Permian and Anadarko Basin and where you guys are drilling, those are all old salt beds. And so that's very brackish saltwater beds that, you're not drilling in areas that would be contaminating any well water, or where, water supply is coming from for potable, drinking water. And so I want you to speak to that. I think where, you guys are definitely doing directional fracking, which has really increased your success and accuracy. I mean, I can't remember the last time I saw on your track record that you guys drilled a dry well. It was definitely over a decade ago.
Right. Yeah, no, technology has really changed the nature of our industry. Horizontal drilling, multi-stage hydraulic fracturing are, I would say, two of the leading candidates there for why that is. But yeah, I mean, if you look, I guess, specifically at the well design, and look, face it, there's a stigma that surrounds our business as being just dirty in general, or very lackadaisical with any consideration to the environment. And I cannot tell you just how big of a myth and how bogus that is. Look, like I said, at the onset of this, when you had a chance to see kind of that bird's eye view of where our district offices are located, we've got 380 employees out in these areas. Fresh water, just as it is, important to any one of us that's maybe listening to this call, it is the lifeblood as well of these rural communities, especially those that outside of oil and gas are ag-based. And I find it to be very self-centered when you see politicians or anyone else for that matter come up with these just fly-by-night accusations with regards to how the oil and gas industry is just out there knowingly polluting fresh water and streams and rivers and whatever else. It's the lifeblood. We've had people out there for decades and generations. Anything they do to knowingly harm their water table is going to have an impact on their family. And so the idea that people are out there knowingly polluting these sources is just absolutely crazy to begin with. But so what are we doing, I guess, to try to protect these sources?
Chris, just to chime in here for a moment, I think it was fascinating when I was out there because, everyone's seen the Hollywood film with Matt Damon and the fracking and I think that what was it called?
There was Gasland was a documentary, and then I can't remember the other one that
was-
Damon was in. But
Yeah, but I think it was fascinating when I was talking to some of the engineers and the team there that's doing the fracking, the directional drilling, and where the fracking got a bad rap. And one of the engineers was sharing with me that it was really in the Appalachian, Pennsylvania, that area that had been drilling, and they had not been drilling for all that long. And so they didn't have a real regulatory code as to what to do with dumping. And so they started dumping it and not doing it in an environmentally friendly way. Whereas Texas and in the Permian Basin and where you guys are located, they've had regulation in Texas for, I don't know, decades. And they've been doing this consistently. They have very strict regulations. And so that was really where I think it was an isolated area. There was no regulation in those areas. And I don't know if you can speak to that for a moment before you kind of get into this.
yeah, I mean, look, you've had oil and gas development across this country for, coming on close to 100 years. In fact, the first well ever drilled was up in Pennsylvania. The fact of the matter is the formations that we're targeting as an industry today would be in large part classified as non-conventional, otherwise meaning that they are deeper, tighter rock formations that have very little natural permeability and very little, if any, natural, porosity. Permeability being the ability of a trapped hydrocarbon to travel from point A to point B, and the porosity being the measurement of the pore space that you're then allowing these areas to otherwise connect. If you have high permeability, if you have high porosity, there's no reason to go in and stimulate this. That, of course, would allow any source of fluid down there, whether it be water, whether it be crude oil, whatever it might be, to essentially migrate naturally. But it's very difficult when you're talking about these tight rock formations for that to happen. But you're right, in terms of, I think, where companies have otherwise run into any sort of regulatory issues with regards to contamination, in large part it's been on the disposal side. And specifically, it's really been on saltwater injection, which is where you're taking your produced water and actually injecting it into a formation that'll accept it. They had some issues up in Oklahoma with that in terms of overpressurizing some of these injection wells, and in some cases, I think they actually lubricated an existing fault that was there. They've shut a lot of that down, and you'll see here in a second on one of the other slides as far as the investment we've made as a company to try to help recycle and treat a number, or actually a large majority of our produced water. But anyways, if you kind of look at the engineering, and just design and framework of an oil and gas well, we can't go out and just drill a well anywhere at any point in time. We actually have to get a permit approved by the state authority, or if it's on federal lands, obviously by the federal authority, specifically the BLM. And then, of course, you have to stake your well. And from there, you have to submit your well plan or your well design, to that local authority, and they have to approve it and sign off on it. And what they're doing is essentially making sure that we are providing the greatest amount of engineering, if you will, in the areas where it's going to be most sensitive, where you could potentially encounter fresh water. And so I know that there's a kind of a rendering here, an illustration in a couple more slides, but what we're doing specifically is actually putting three strings of casing and then cementing those in place.
Let's go to that. But before we go to that too, just on the water, if you go to the next slide, Jim, what you guys are doing too is you guys are, trucking off a lot of the water yourselves, which is saving about $1 to $2 a barrel at this point.
Yeah, I mean, actually, very little of it is trucked at this point in time. I mean, if you think about what we've done, and I'm talking really industry-wide, but I guess I'll look at it as a company too, in terms of just reducing our carbon footprint. More and more of your production, be it water, crude oil, or anything of the like, is actually being moved, without any sort of, trucking needs. It's being moved with within a network of pipelines. In the case of crude oil, below ground infrastructure; in the case of water, above ground. So, that's obviously in and of itself reducing emissions, just because you're not having to send, dozens, if not hundreds of trucks to and from location to move your water and your oil off your tanks. But more specifically, I think what's most important about this slide here is, I mean, to put it in perspective, guys, it's not uncommon as the industry today that when you're completing these wells, stimulating them, fracking them, whatever term you want to use, that you're using maybe 20 million gallons of water in that completion process. And previously, up until the last 4 or 5 years, we were just taking that water and again injecting it back into a formation that would accept it in what's known as a saltwater disposal well. We basically tasked ourselves with figuring out a way to treat that water and reuse it for a couple of reasons. One, environmentally, it makes sense. And two, like you were mentioning, Christina, economically, it makes tremendous sense. The cost savings are spectacular here. It's been a sizable investment, but it's been one that's been well worth it. But it's to the point now where, you know, approximately 75% of the water that we've used in a prior job, we're able to treat and reuse in another job. That's 15 million gallons of fresh water that we're not utilizing and then just ejecting in any given well. And if you're going to drill, you know, 150 wells this year, give or take, you can do the math pretty quickly, and you start to see the benefit there, not only from the environmental but also the economic perspective.
Jim, could you go ahead before we kind of go back to the legislative? Can you jump ahead one more slide, and then we'll go back. But I think this is also really key, and this is kind of a visual of how it was explained to me when we went out there to the physical site. And you can explain this, Chris, but this was also I think very helpful in understanding fracking and what the protection and barriers are to make sure that there's no spillage or environmental or EPA concerns.
Yeah, so exactly like you were saying, in most cases, you'll actually start here with, an 18-inch, or sometimes it's, 15 5/8. But when you submit your well design and your plan to the local authority, they'll basically have you run what they call surface casing for the first, I don't know, anywhere from maybe 150 to 500 feet. You then cement that in place, and casing is steel pipe. So you basically, you drill your 150 foot or 200 foot or 400 foot, whatever you're required to, and then you run your casing string in there. You cement that in place by circulating cement back up to surface, and then you'll go back in and in your next layer of or next string of casing, it might be 9 5/8. And you're going to run 9 5/8 down maybe all 10,000 feet. If you're going to go 10,000 feet vertically before you kick off, you're going to cement that in place. That's your intermediate string of casing. And then from there, you're going to run your production string basically all down through your curve and then out the entire lateral length of the well. And you're going to cement that in place too. So in the most sensitive areas where you're potentially going to encounter fresh water, you have at least 2, if not 3 strings of steel and concrete protecting you against those formations. So in addition to that as well, I mean, you have different pressure sensors that can determine if you're actually dealing with losses of pressure. And if you see those things, you're not just going to continue to sit there and produce your well. You're going to figure out where it is and what it is, and you're going to go in and isolate that and take care of it too. So again, I can't say that you haven't had, for lack of a better term, rogue operators or companies that are out there with less than a lack of concern for the environment and for the reputation of the business. But in large part, when you look at our industry as a whole, we do a darn good job of not only complying, but I think exceeding of what the regulations are that are in place too. And this is just one example of that.
That's really helpful. So yeah, I think if you want to just go back to slide 14, Jim, to just the legislative considerations, and then we can just talk about the cash flow and open it up to questions.
Sure. Obviously, it's to be determined, right? You turn on the TV and it seems like there's a new focus every day on some new bill or some new way to spend our grandchildren's money and great-grandchildren's money. But that's, I guess, beside the point. What I think you're going to continue to see, and what we have seen so far, is a continued emphasis on, renewable energy sources. There's probably going to be some increased regulation on the fossil fuel industry, if you will. And of course, we've seen some attempts thus far to potentially close deductions for high-income households, and by that, I guess, just higher taxes as a whole. But if we were to, I guess, kind of try to summarize what some of those mean, I mean, clearly on the more extreme side, you've had some on the, I guess, progressive side of the Democratic Party talking about, the Green New Deal and whatnot, I would say that still continues to be just nothing more than conjecture. However, you are seeing some efforts to take parts of that proposal, if you want to call it that, with regards to the Keystone XL pipeline, which of course was just killed essentially. There was an order that the Biden administration signed back in late January that put a temporary halt on the federal leasing program and essentially stripped the local bodies of their authority to approve leases on federal lands. They went ahead and let that expire, although they haven't exactly released the findings of their review. Although a judge in Louisiana, I think it was 2 days ago, issued a ruling that was in favor of, I think it was the 7 or 11 states that actually sued successfully to try to put a stay on that order. But nonetheless, guys, it's clear, just based upon the conversation that we've seen thus far and the narratives thus far, that the taxes are going higher, spending's going higher, and I think in some ways you're going to see some of that spending geared towards renewable energy sources. What does that mean for us as an operating oil and gas company? Guys, at the end of the day, all we can do is comply with the rules and regulations that are in place, and that's what we do. We have a very good working relationship with the municipal and state authorities in not only New Mexico, Texas, and Oklahoma, where we operate, but we do so at the federal level. But again, at the end of the day, if they change the rules, we figure out ways to comply with them and we move on. Because despite what many people have heard, while the future of energy is going to be greener and is going to be cleaner, the future of energy for the next however many decades to come is also going to include oil and natural gas as well too. And so the commodity that we produce is going to be in demand, and we fully expect to continue to be a part of it. And we're going to be a part of that conversation, like you've seen previously, with regards to different ways that we can try to do things better, more efficiently, and more clean and green for the environment.
And I think that's a good, you brought up a lot of good points, Chris, because I get a lot of questions. I know Jim gets a lot of questions from clients, well, isn't, California's going to go to electric cars? Well, until California can figure out the electric grid and power, I think that's not going to happen. But
hey, don't jinx us. It's hot everywhere.
Yeah, if we keep having rolling blackouts.
The California and Texas, they were talking about intermittent power shutoffs.
Yeah. Voluntarily, they were asking people to turn their thermostats up 2 degrees in East Texas, where again today it's supposed to be 100 and whatever on the heat index, and I can assure you that that's probably not happening all that often. But hey, conversely, it's somewhat of a running joke nationally because we actually had a real winter in Texas, but the state came awfully close to blacking out in its entirety in mid-February when we had that winter storm that basically was a 100-year storm and brought below freeze, and not just below freezing, but we're talking below sub-zero temperatures.
Hard freeze.
In fact, one day here in Tyler it was -7. We weren't just breaking records; we were just shattering them. And we came within minutes. The state did. The regulatory authorities said because we lost essentially all of the wind and solar input that was contributing to the energy grid. We lost it almost instantaneously, and thank God that we had enough natural gas to back that up, or else this entire state literally would have blacked out. And I can assure you, as having a gas fireplace, I wasn't looking forward to having my entire neighborhood over, sleeping in my living room while we tried to stay warm. But it beats the proverbial horse to a pulp, if you will. Because I think we all appreciate, again, that the future of the energy grid as we know it is going to continue to migrate towards renewable sources, but that conversation is going to be had in terms of decades. It cannot legitimately be had in terms of weeks, months, or years. Let me just mention one other thing on this, and then we can start, I guess, maybe wrapping it up or seeing if there's any questions. But, Christina, like you and I were talking at the onset, there is a proposal that was recently floated by the chair of the Senate Finance Committee, Ron Wyden out of Oregon, that would potentially amend how it is that you're able to realize the intangible drilling cost deduction. It did not repeal it. It basically said, as opposed to being able to take it as received, you'd have to amortize that over a 60-month period, i.e. 5 years. It doesn't appear that it's been gaining much support. In fact, it was part of, so far as I know, this larger infrastructure package as a means to help generate revenue for it. And I guess based upon some things we saw yesterday, there were Manchin, Hickenlooper, Gene Shaheen, and I think there were 4 other Democrats that came out and basically said, look, we're revenue neutral from here on out. you've spent enough. The conversation outside of budget reconciliation, which they've got one shot at if they're going to do anything, is for all intents and purposes, it seems pretty dead for tax year 2021. So it could very well be a live discussion going into next year. But that is something that I think is important to understand, that at least there's some proposal that's been floated in some way, shape, or form that would potentially impact slightly how it is that loss works.
Chris, how would that negatively impact your company, that legislation?
Yeah, I mean, look, if I can
my view on that is whether you take it in 1 year or 5, you're going to get it, right?
Yeah.
It's better to have it obviously quicker, but
yeah.
If you have any questions,
look,
go ahead and put that in the Q&A button, click the Q&A button. And if you're watching this on YouTube, you can go ahead and put questions or comments, and we look at those frequently. But yeah, go ahead and put it in the Q&A button and we'll continue the conversation.
Yeah, and just one last thing I will say with Chris is, Mewbourne has had a working relationship with multiple different administrations. They've got close relationship with Governor of New Mexico, and the whole not being able to drill on federal land. You guys don't really have a whole lot of drilling on federal land. You guys already have your leases locked up, and it's not going to be a huge detriment to not having that opportunity. And you guys are comfortable working throughout different administration and tax policy. So Jim, if you can go back to slide 15 though, because I did want to talk about the cash flow. That's the one thing that we didn't talk about.
This beautiful graph that you put together, Christina.
So this is just kind of a rough example of how the cash flow works. The production on a well is not linear. The production on a well is going to kind of do this. And what's the average lifespan of a well, Chris?
I mean, the economic life is, probably north of 30 or 40 years. I would say typically a partnership, though, would maybe be 12 or 15 because of that diagram you kind of just outlined, in that you're gaining or you're getting or producing a large portion of your reserves in the first, 10, 12, 15, 18 years.
Yeah. So if you have, kind of call it a 15-year, timeline, and you're going to have a peak, maybe years 3 to 5, maybe years 7. What a lot of our clients are doing, especially when they're in a high tax bracket, they are taking, they're doing this year after year, getting the deductions. And then maybe that when they're in retirement, other than their required minimum distribution, maybe they don't need to do as large of investments into this for as large of an upfront tax benefit. But the beauty of this is, if you layer it in year after year, you start to kind of ride that crest of good income because you hit those peaks of different wells at different times. And so that royalty income that's coming in is going to come in for 12, 15, 18 years. And you're going to get continuously just different distributions. So typically, if you're raising capital in July, August, September, your first distribution is Q1 of that next year. So Q1 of 2022. And it's usually quarterly for the first distribution because you don't have as many wells that are operational kicking out income. And then typically Q2, it's monthly from that point forward. And then clients are getting a monthly distribution. And as Chris mentioned, there's the tax shelter on the distribution side as well, so that a lot of that income is federally tax sheltered. And then you guys do model out, which I know we have a question, but you guys do model out what the cash on cash break even is. And typically, if you're at $35 a barrel, what's your cash on cash break even? What's the different break points?
Yeah, I mean, this looks at it from the perspective of the partnership, but when we've run it today, if you look at your current costs, if you look at your current production, or what we call EUR assumptions, if you run it at $30, it would take you probably 10 years to get your initial capital back, with maybe a slight return, on top of that. So if you're in it at 35, you'd expect to see something slightly above that. We've run it at 50, and at 50 it takes you using those modeling assumptions probably around 4.5 or 5 years to get your initial capital back. So of course the higher price you assign to your production, the shorter the window you would expect to have capital at risk. The lower price you assign, the longer it would take you. Now of course, past performance is no guarantee. These are just that assumptions, they're estimates. But when you look at I guess the variables that exist within our industry, really the two biggest ones at this point in time now would be, or I guess the three would be your cost, your production, and then the price you sell your production into. We've got a good handle on our costs, because what we just went through last year, there hasn't been a whole lot of upward pressure on the industry, on the service work side, as the industry is still in large part, recovering from the swooning price last year. We've been drilling wells in the same two areas for the last 50 plus years, in large part of this developmental drilling. And so we've got a good handle on our reserve assumptions, our production assumptions. So the biggest variable that I see in large part is really just price. And you can have a conversation about, where you think prices will be a week, a year, or 2 years or 5 years from now. But if you can get a good handle on your costs, and if you can get a good handle on your reserves, then historically price has been able to take care of itself over time, and that's the approach we've taken.
So that answers Peter's question. How much dollars per barrel of oil to break even? It sounds like 30-ish is kind of the short.
30 would be a number that I would say I wouldn't call it just a hard line in the sand. I mean, you'd still be able to cover your operating expenses if prices went below that, but it would be increasingly challenging to be able to recover your initial capital.
And what is the price forecast for oil? I mean, it's a who knows, but what are your industry associations kind of looking at over the next few years?
I was looking at the forward strip the other day, and it still has prices in the 70s as you go out, 12 or 24 months from now. Okay. I think a lot of that is driven in part by the fact that there's an assumption that the global economy continues to reopen, if you will. And if you go back and look at where we were, pre-COVID, January of 2020, the global economy was consuming 100 million barrels of crude oil a day. We're somewhere, I think, depending upon who you listen to, in the 94, 95, maybe $96 million or 96 million barrel range. So we haven't recovered all of it yet. But if a fair price for a barrel of oil was in the mid 60s pre-COVID, who's to say that it's not that same price today, especially when you consider the fact that there's just simply not the same level of investment that's taking place. And so, like you said, I don't know that anyone can predict accurately where prices will be a year or two from now. But if you look at some of the underpinnings of not only the demand side, which is clearly starting to clear up some as you've seen, growing inoculation and whatnot, but also on the supply side, where there's just been a severe lack of investment taking place, there tends to be a fair amount of support for prices where they're at today.
How about like steel shortages? Does that impact you guys? Because that takes a lot of steel for the pipes. Where are you guys on that? Are you having to delay drilling because of the material shortage?
That's a good question. In fact, the only thing that we potentially would have seen any issue with would be on the steel side. Hasn't been an issue so far. I mean, in terms of being able to get it, we are starting to see some increases in cost on that side. But when you're talking about spending, $7+ million on a well, I have to pull up an AFE to see exactly what it is on casing and drill string. But even if you saw a 10 or 15 or 20% increase there, I would say that wouldn't be considered material in terms of the overall cost of the well itself. Outside of that, I'm not familiar with any issues that we've had sourcing any needs, either tangible or intangible.
The one thing I want to make sure that we discuss is, I think while on this slide is relevant to is track record and risks. And with the track record, you guys do have audited financials and audited track record provided in your private placement memorandum. So if this is suitable for the right client, you can get access to, if we can determine that this might be of interest, there is a full private placement memorandum that has audited track record in it. And speaking to kind of the risks, part of the reason as well that this is usually part of an overall tax planning strategy, and most often our clients are doing this year after year as part of an overall plan. The other reason to do that is really for diversification and catching different years. So for example, your 2015 partnership, I think it was in 2015 when oil fell to $29 a barrel. 2014, 2015 is $29 a barrel. those
Yeah.
clients probably took longer to break even on their cash on cash returns. Obviously, you're getting a large percentage of your return in the tax benefits on the front end, but like true capital in the form of dividend and royalty income distributions took a little longer. But then you have clients that invested in 2016 and 2017 that rode the wave of the price appreciation. They got in low while the costs were real low, and they rode the price wave, and they got their cash on cash returns very accelerated on the front end. And so, the risk it really would be, I would say the risk is probably less these days with the technology, engineering, directional drilling of drilling a dry hole, and you're in a pool of, multiple wells that are getting to well diversification. So it's not one well, but I would say that the risk is, what's the price of oil going to be, and how is that going to impact your cash returns? And certainly in 2020, distributions went down because demand went down, but those are picking back up again. So, that's really where I'd say that the more diversification you have in multiple year partnerships, the more diversification you're going to have in your cash on cash returns.
Peter asks, what is the percentage of hitting oil versus dry hole? I mean, how often does that happen?
It has happened in a decade.
Yeah. I mean, the last time we drilled a dry hole was in 2009. And that's due in large part to just the nature of horizontal drilling. If you're not familiar with the technology, for 80 years in this country, substantially every well that was drilled was drilled vertically, and you completed that small vertical section. Your dry hole risk was far greater there, because you were basically chasing trends, and you were going to encounter across that 30 wells or whatever it is that you might drill, there was going to be areas where there wasn't productive rock that you were going to try to complete into. Now, as opposed to drilling 10, 15, 20, 30 wells, whatever it is, you're drilling a single well. You're drilling it vertically to where you get the kickoff point, where you actually start making a 90-degree turn, where it takes you about 900 feet to do that. And when you land at your 90, you then go out horizontally for, in some cases now, 10,000 feet, and you're completing that entire 10,000 feet. And so you're encountering, good rock, great rock, bad rock, decent rock across that entire formation, but you're completing the entire thing. And so the dry hole risk in and of itself has been reduced greatly because of that technology. But if you go back over the life of the company, our completion success rates of 3,000 plus wells, this is vertical and horizontal, is I think north of 92 or 93%.
Yeah. And Christina, I'll just kind of close with this question is, so if I'm making 500 grand a year W-2, and I've got $1 million in, kind of cash savings or investments, is there a minimum on this? I mean, how does that work? Walk me through that. Is this like, am I putting all of my investment in here, or a portion, or just unpack that a little bit?
Chris, what's the minimums typically? Obviously, we can't talk about
20,
a specific partnership or, make a general solicitation, but typically what's your average?
20,000 would be the minimum. The average investment's usually 75,000, give or take.
So bite-sized pieces, basically, right?
Yeah.
For most
Yes,
people.
sir.
Right.
Yeah. And so that's where, if obviously, because this does have to have, quite a bit of due diligence to determine if this is suitable, this cannot be a general solicitation for clients.
It is not.
And it is definitely not. And so should you have interest, obviously you'd want to go through Cunninghamlegal. And if they think that there's a need, and then we can certainly get involved. And we work closely with a lot of mutual clients.
All right. Well, thank you, Chris and Christina.
Thank you, guys.
Thank you for a great time together. And thank you for watching. And remember, subscribe to our YouTube channel. We'll see you next time.
Thanks, everyone.
Take care, guys.